My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is John Cochrane, the grumpy economist. I want to know how grumpy you are trying to install X on your phone. But John, introduce yourself to the audience and to me. First time you and I are chatting. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yes, I am the grumpy economist. That's the name of my blog. I spent 30 years as a finance professor at the University of Chicago Booth Business School of Business. Now I am a senior fellow at Hoover here at Stanford. I do finance. I've done finance. I do a lot of inflation, stock bonds, and I comment on economics in general. Write op-eds occasionally, and I talk to interesting bloggers and podcasters just like you. And I spend frantic mornings installing X on my phone.
So I think one of the things people often say or put out there is there's a difference between the academic side of finance, of investing, and then the real world. Do you think there's elements of truth to that, or is it a lot more nuanced than people think?
Oh, I think there's a lot of truth to that. One is sort of so my job is as an academic is to understand markets. Why do prices go up and down? And your job in the real world is to try to make money. Another big one shows up. Academics, there's this funny difference of opinion. How efficient are markets, how easy it is to use to make money. Where academics start understanding there's a zero-sum game here. So if you hold anything other than the market portfolio, it's zero-sum. For anything you win, somebody else has got to lose. That makes systematic investing much harder than most people, I think, in the markets think everyone can win. That's not true. And so we look at things a little more dispassionately, try to find evidence on what actually works over the long run.
So you mentioned, I think you said 30 years on this side of things. Has that point about market efficiency been more and more accepted as not being fully true by the academic community? I mean, I think, back in the late 80s, early 90s, that was sort of a doctrine. Now, maybe not so much.
No, I'll push back on that. In part, the original market efficiency, if you read Gene Fama's original papers in the 1960s and 1970s, it's always clear that markets were not fully efficient. So it's always been a glass half empty, glass half full kind of question. And let's remember what efficiency means. Efficiency means, do prices incorporate available information about cash flows? Or is there some easy piece of information left on the table that you can exploit and make money? So the fact is, it's awfully hard to consistently make money on markets. And we look at, as academics, we look at the performance of active managers. And if you get rid of the selection bias that you only talk to people who made money, it's awfully hard to see that they're doing much better on average. So that the glass has always been a little bit empty. There's information, inside information we've always known is not fully reflected in prices. The insider trading laws work a little bit. And there's lots and lots of, in fact, academia may be ahead of markets now. As you read the pages of the Journal of Finance, and there's lots and lots of claims of easy ways to make money. And yet people I know on Wall Street try to use them, but they don't work in the real world. So it's hard to make money. I don't think I'm telling you anything new there.
Yeah. And I do get the sense that survivorship bias is underestimated by a lot of investors and traders when they look at, the so-called greats, not realizing just how many people have failed.
Yeah, so let's just be clear about this. Survivor bias is one of the clearest stories to keep in your mind. In fact, a lot of what I say, I had to justify my job for a long time. I charged MBAs a lot of money to come here, tell them that the markets are efficient. What's the point in that? Well, you got to get a good set of bullshit detectors on, because there's ways to make money, but there's a lot of bullshit out there. And survivor bias is one of the best stories to remember. So if you just look up in the phone book and say, hedge fund, and you call them up, they all have great track records. Why? Well, the ones who didn't have great track records aren't in the phone book anymore, or, the modern equivalent of the phone book. So when you want to evaluate what can I do going forward, you have to make sure that any of the data you do doesn't have this selection that only the successful strategies are in the data.
Yeah. And this is kind of speaking from experience. I get the sense that the other thing that's also underestimated that related to the survivorship bias is that in reality, most things are driven by the overarching cycle that you're operating in, right? So a lot of active managers have had a hard time the last decade because it's been an environment of, largely risk on, up and to the right, large cap, FANG, tech type of momentum. It's hard to really beat the S&P when it's the only game in town. So I do think that is a component, right, from a business perspective in terms of when you launch the cycle, favoring your approach, and then can you survive long enough to see the next cycle?
Yeah, and I would put the words there, allocation versus selection. How much of performance is simply having ridden the right wave of stocks versus bonds, value versus growth, tech versus something else, and how much of that is within that category, who is able to outperform the broad strategy. And if you're evaluating a manager, are you evaluating someone for their ability to catch broad trends? Good luck to that. Or their ability within the trend to do better. So, at a time when value, say, went down 20%, somebody who only lost 15% is a spectacular manager. But it takes some discipline to understand that fact. And whose job is it? Is it your job to choose the allocation, or is it the manager's job to choose the allocation? Be clear about that discussion. What we know is that the allocation decision is far more important than the selection decision in understanding how people make or lose money over time.
Right. I always stress that point. That goes back to the Brinson, Bieber, and Hood studies on asset allocation. I always go back to, if you want to beat the average or if you want to beat the market, you have to choose the right market in the right cycle, right? And that, I think, missed by a lot of people.
Yeah, exactly. And cycles are awfully hard to tell ahead of time. They're awfully clear in the back, looking in the rearview mirror. Oh gosh, what a bubble. Anybody could have known that. If only I could have gone back and bought in March 2009, I'd be a rich guy today. And it was so obvious. Of course, that was the bottom. Wasn't obvious in real time.
So it's funny you say that, because this is one of those great frustrations that I have as somebody who puts a lot of content out there, and people, use technical analysis, what I call squiggles, right? Things which are not back tested or have any predictive power. They look at charts, they're looking at daily, weekly, monthly, and they're saying, oh, look at this and look at that. Every single one of those bars is, if it's a daily chart, 24 hours. Imagine going through that every single day. It's easy to not only look with hindsight at different periods, but to not appreciate the time it takes for something to play out. Is, I think, another massive underestimation by investors.
Yeah. Yes. And I think a good habit is not to think about the decision, but to think about the rule. What rule am I going to apply consistently over time? And how does today's decision fit into a rule like that, as opposed to, oh, wow, looks great, let's go buy.
So I'm going through some of your posts on blogspot.com, and you got one on interest rates and inflation, part 2. Maybe we talk about part 1 first. Losing faith in VARs and value at risk. And it looks like you touch on the long and variable lags dynamic, which is often out there. Now, just taking it to the most recent movement today, a lot of excitement around inflation coming in softer. And I put out a post, earlier before the market opened, saying, whatever you're seeing on inflation now is not from interest rate hikes the last several junctures. It's from interest rate hikes from the start of the year, because there are delays, right, on monetary policy and the economy and markets. From an academic perspective, do you believe that still to be the case? Is there an argument that the lags are not as laggy as they used to be? Talk through that part, because I think this is where timing mismatches, which relate to whatever cycle you're in, becomes really critical.
Well, here I have the kind of actual news that doesn't make great headlines. So I'll advertise. I just finished a 600-page book on where does inflation and how does inflation interest rates work. It's called The Fiscal Theory of the Price Level. I've been working on this stuff for 20 or 30 years. And I say that just as preamble to the one thing I know for sure is that nobody else knows. So the whole question of how do interest rates affect inflation, and the Fed likes to pose as a great technocratic marvel. They know exactly how this thing works. Commentators like to say they know exactly how this thing works, but the blog posts you mentioned as well the book, we really don't have well-tested theory or a good empirical understanding of how interest rates do or don't affect inflation. In fact, there's kind of a funny tension that there's this belief of long and variable lags. Raise interest rates and, a year or two later, somehow that softens the economy. And a year or two after that, that brings down inflation. Okay, maybe not. All of the current models, the last 30 years, everything in the Fed's models doesn't work that way. It says higher inflation lowers, higher interest rates lower inflation right now. Well, evidently it doesn't, because look out the window. And there's another deep question is, where does inflation fundamentally come from? So why did we have this spurt of inflation? You can't start to answer, is the Fed going to cure it, unless you talk about where it came from. And it's quite clear in my analysis, this inflation had nothing to do with the Fed. What happened was that the government dropped $5 trillion of money, sent people checks, they went out to spend them, and boom, you get a burst of inflation from all that extra spending. But that burst of inflation goes away on its own. It was a one-time thing until they sent us more checks, which they're in the process of doing. But really, the inflation came and went as a result of this fiscal policy, and the Fed was kind of on the sidelines. And now we're in this great puzzle period. We're supposed to have a recession. What is it now? A year or two ago? The standard theory says is you raise interest rates, that causes a recession, that brings down inflation. But we haven't even seen the supposed recession. So raising interest rates isn't doing what it was supposed to do by the theory. And I think what we're seeing with the inflation has nothing to do with the interest rates. Therefore, in fact, because in fact, the inflation is just the working out of that pandemic extra spending. So where we go in the future depends a lot less on the Fed than depends on, are we going to get fiscal policy?
Yeah, that's the whole fiscal dominance argument, right? It's the fiscal side will matter far more than whatever the Fed's trying to do on the inflation front. But going back to that point about the link between interest rates and inflation, I've got to assume that's not true at the extremes, right? I mean, if you lower rates to negative 25%, and what my father referenced in a course he was teaching in Merrill Lynch in the late 80s, you'd have very high inflation. Right, because you're borrowing money. We'll give you money to borrow money. If you raise rates to 500%, next week, you'd have an instant depression. So maybe it's in the middle where it's not as clear the linkage, but at the extremes, I think you can argue there is clearly a cause.
Maybe I think there's a big thing that's changed is that all of our experience back in the 1980s, whatever, is that when the Fed raised interest rates, it did so by lowering money supplies and lowering bank lending. It really the Fed made it hard for banks to lend money, created a financial constriction. Currently, when the Fed raises interest, it just raises interest rates and doesn't do anything directly to constrict things financially. So no wonder you're not getting the recession depression that you thought you might have gotten. It's a fundamentally different tool. Now, I think that's a great and good thing. That creating financial crises in order to lower inflation was probably a very roundabout bad way of lowering inflation. But you can see the result right now. They're raising interest rates, having no effect whatsoever on the economy. People just happily pay the higher interest rates.
How does the psychology play into that? I mean, nobody really talks about velocity of money anymore, but that, is a driver, at least supposed to be, of inflation, transactions changing hands faster. To the extent that consumers believe rates will keep rising, that could result in them spending sooner, right? To take advantage of relatively lower rates compared to where they think rates will be going forward. So I've got to assume there's a psychological element to this too, which is hard to model.
Well, I don't call that psychology. I call that expectations. So if you use the word psychology, you're saying, the consumer is dumb. And there's a lot of, the consumer is dumb and people have irrational expectations and so forth. But I don't know where inflation's going to go. So it's hard for me to say that somebody's beliefs about that. But you're very right that beliefs about inflation are crucially important to where inflation goes. Now, that's a very deep statement with big effects. And let's just, why is it true? Well, you're a business person and you expect inflation next year. What do? You raise prices now. You're a worker and you expect inflation next year. What do? You're looking for a job. You say, no, I want a higher wage now. So if people expect inflation next year, then you get inflation now. And anybody in markets understands this. If everybody knew the market was going to go up tomorrow, they'd buy and the market would go up today. So that's why the expectations, at least in the short run dynamics, this whole thing the Fed talks about anchoring and making sure people don't believe it's getting out of control is important. But why would people believe it's getting out of control or not? Well, you might just say, it's all psychology and people believe what they want to believe. But a more sensible thing is people believe in the Fed, that people believe in the government institutions, that they'll do the right thing to get rid of inflation in the future and therefore don't worry about it. And that calms inflation today. So when people lose faith that we have a sensible government that can and will do what it takes to control future inflation is when inflation starts to break out today. And I think that's not psychology. That's the exact workings of an economy where the essence of our economy is all market psychology, market expectations, what people expect about tomorrow, which affects a lot of what happens today. And what they expect about tomorrow depends a lot on stable faith in institutions, which once you say that turns you into a grumpy economist about the dangers we face.
Yeah. And there's some interesting studies and thought leaders who have made that point that, when trust arose in the government, there's an inverse correlation between inflation and trust in the government.
Yeah. Now, but let's also, lots of people say we need to have more trust in government. No, the government needs to earn our trust. The government has been screwing up right, left, and center in all sorts of ways. So it's good reasons people don't trust the government.
I wonder how I think maybe social media has altered the firmness of that anchoring around inflation. I mean, to the extent that the algorithms are constantly pushing, all these price changes in a carton of eggs, right? There's always a confirmation bias to what we're seeing content wise. Do you think at the margin that might also sort of change the way inflation acts and consumers act?
I don't know. Hard to tell. I don't see, it's hard to see evidence that markets have become more efficient. If anything, there's evidence that, as we move to an electronic age, markets became less efficient. There's sort of weird stuff that happens in high frequency markets that didn't used to happen. And I don't see evidence that price dynamics are changing that much. I guess airline prices move faster now that we buy them online rather than having to call up a ticket agent. So some prices, by moving online, move more quickly. But I don't see, inflation dynamics happening much quicker now than they used to in the 1970s or so.
So I named this space the mortgage puzzle based on, again, one of your posts. And it is interesting that the housing dynamics in the States are obviously very different than other countries because our mortgages are more on the fixed side, whereas others reset, which I think makes the whole dynamic really challenging from a cycle perspective. But talk through what you term as a mortgage puzzle and why it matters.
Yeah, so this is fascinating. So what's going on? One of the stories going on right now about mortgages. So interest rates went up a lot, as all of your listeners know. And many households had refinanced or bought 30-year fixed mortgages. And so they are sitting pretty. You get to make payments at 2 to 3% for the next 30 years when money is costing 5%, so forth. Coincidentally, the federal government, and I think one of the most catastrophic decisions ever, chose not to do this. Just as everybody else refinanced a 30-year fixed, they said, no, let's borrow short because interest rates will always be low and will therefore ride the short end of the yield curve. Right now, interest costs on the debt are spiraling. So the federal government is a household that refinanced itself into a floating rate mortgage just at the wrong time. But back to mortgages. So we got all these people with 30 fixed mortgages. Now, what's that doing? One thing it's doing is it's insulating the economy against the rise in interest rates. So many other countries, most of the countries don't have this 30-year fixed thing. Most of the countries have floating rate mortgages. So when interest rates rise, when central banks raise interest rates, people are faced with payments going up, from 1-2% to 5-6% in a matter of months. And many other countries also don't let you so easily default on your mortgage. So people in other countries will stop spending on other things very quickly as their mortgage payments go up, and they're also mad as hell, whereas the 30-year fixing. So one thing that does is it presumably makes American higher interest rates have less effect on the economy, which actually I think is a great good thing, but it means the Fed is less powerful. If the Fed's power comes from destroying the economy and that leading to lower prices, well, the Fed is less powerful. Well, maybe that's a good thing. I'm not seeing other countries, though, really breaking out into the long forecasted recession either. And so it was certainly something central banks were worried about. But if that were true, then we would be seeing floating rate mortgage countries plunged into recession, and they seem to be doing okay. The other thing it's doing is people are locked in houses. So, why are house prices still so high? Well, one reason is the lack of supply. People would like to move to a different house, but they got the 30-year mortgage sticks with the house. You can't take it to another house, which is an incredibly stupid feature of our financial system. But there we go.
Just to reset the room for the remaining 25 minutes, everybody that's here, please make sure you follow John here on X. If any of you want to come up and ask questions, click that bottom left mic request button. And as always, this will be a podcast under Lead Lag live on Apple, YouTube, and Spotify. Okay, so I think everyone is painfully aware of the inefficiency of the government, and we all see the same spending numbers and debt numbers and interest expense numbers. A lot of people have talked about how all this ends up crumbling down at some point, right? That all this debt load at some point ends up hurting us, and that the government at some point will have to stop. And every time we say that, it just continues to get getting kicked, right? This time seems a little bit maybe more challenging, different, just because it's happening against higher rates overall. What are your thoughts on sort of the trajectory of government debt here? I mean, is there anything that can, one, reverse it, and then two, at what point does it really become the point of no return in terms of how it affects us as taxpayers?
Yeah, I am chastened a bit because I've been carrying around the world is ending sign for quite some time now. And as you mentioned, it hasn't ended yet. But of course, the bubble always keeps going, and then only afterwards are the short sellers. Once the short sellers are wiped out, that's when the bubble ends. And I do think we're starting to see the cracks around this constant ability of the US to keep borrowing and spending like there is no tomorrow. Some of the cracks we're seeing, I mean, the size of the debt is one. Number one is we just kind of hit the brick wall. So when the US tried to increase debt by $5 trillion in the pandemic in order to send, stimulus checks and all the rest of it, some of which was important, but not all of it, we got inflation. I mean, inflation happened because people were not willing to hold much more U.S. government debt. They didn't think our government was able to pay back. That's, why didn't people take all the extra debt of the pandemic and say, oh, great, government debt, wonderful investment vehicle. I'll just sit on this. No, they tried to spend it. So that gives you a sense we're kind of at the limits right now. Now, if our government wants to borrow more, they got to persuade people somehow there's a way they're going to get paid back. And, I think we're starting to see worries about that. We're starting to see difficulties in the decover ratios in treasury markets. We're starting to see long-term treasuries going up. So your first question is, there is a story that it's beginning to be the end. Now, when does it all fall apart? I think the scenario to worry about is not so much the boiling frog scenario that, debt slowly increases and then something happens. The worry is in the next crisis. So what happens when there's the next big crisis? The U.S. wants to borrow another $5 or $10 trillion for stimulus, bailouts, this time for military expenditures. And bond markets say, you got to be kidding. I don't got $5 to $10 trillion of new savings to give you. Then we're you're faced with the problem of interest rates spiral up and, the U.S. is unable to borrow more money. And that's a genuine financial catastrophe. So I think the problem to worry about really is the fiscal capacity problem, that every crisis needs a spark. So the next crisis might be the time when the U.S. finds itself unable to borrow lots more money.
I think it was Mike Wilson who brought up that argument. Like, the worst recession of all would be a recession where, rates rise. But you think about it from like an investor perspective, I don't see how you can make money off of that. That's like an end of the world type of scenario, right? You're talking about the entire system and being up.
Yeah. And I don't know, which parts of the world in first rather than later. It is hard to give investment advice. There is sort of the, I think the Ron Paul portfolio, which was, cans of beans and gold bars and ammo, but that's a very low return portfolio if the world doesn't end. And of course, if the U.S. ends up in a fiscal crisis, you can invest anything you want, but they're going to grab wealth one way or the other. So it's going to be very hard to keep your money safe if a genuine fiscal crisis breaks out. And now how can we reverse it? This is a self-imposed crisis. You got to bring long run spending back down towards where long run tax revenues are. So this is a 5-minute problem in economics. Get supply side growth running again, because you need long run tax revenues over 10 to 20 years. Reform the entitlements. So you're spending roughly, you're helping the people who need help without throwing money out the window. The rest of Washington has to wake up that when you throw $1 trillion at something like electric cars and windmills, that's got to come from taxpayers sooner or later. And if it's not a productive investment, you got to make sure you're spending money wisely. Fairly straightforward to do, but as you can tell, the political will in Washington for closing 5 to 7% of GDP structural deficit gap, there's not much will to sort of those kind of serious reforms.
Going to your point about, they're going to get their money just through taxation. I made that point too. That's why, to me, it doesn't make any sense, the argument that you can keep on having a duration crisis in treasuries, but not a corporate credit crisis, because, they'll tax them. But maybe the counter to that is maybe there's just not any political will to tax anyway, that we're at a point in democracy from a corruption perspective, we're going to hold from a lobbyist perspective where there's just no incentive to actually try to take money to pay off the debt. So the U.S. government can be in crisis, but they don't have any ability to tax us to resolve.
Well, I think it's more subtle than that. I think we're pretty close to the top of the Laffer curve. Now, I know somebody might, this is Twitter, so I'm going to hear no end of having said that. But the long run.
Well, but explain the Laffer curve.
And by that, I mean the very long run Laffer curve. So is there a capacity for the U.S. government with the current tax system to actually extract lots more money out of the economy without cratering the economy in the process? We know that at 100% tax rate, the government gets no money. Nobody works. At 0, the government gets no money. So there's somewhere in between where they're getting the most amount of money they can. And high-end marginal tax rates, all in, you got to count the state, local as well as federal tax, sales tax, everything else. So the high end marginal tax rates are already in the US well above 50%, 60 or 70%. Is there room for squeezing lots more money over decades out of people without killing the economy? That's not up. Now, there is a way to do it, which is you get rid of this obscene Swiss cheese of a tax code, a supposedly very high marginal rate, but lots of exclusions, deductions, and all the rest of it. Replace it with a very broad-based, low marginal rate. That lets the economy grow and you make a lot more revenue over 10 to 20 years, once the economy starts growing again. It's not so much lack of political will to go get those damn corporations and all their money. We're already taxing them pretty darn high. And we've already seen, the last set of tax cuts did actually raise growth and revenue. But really, it's political will to put in a simple, at low rate, wide base, everybody pays a little bit pro-growth tax, where nobody goes to Washington and gets special exemptions from high rate. That one's actually harder politically, but that's what you got to do. That's a great question. We got to bring immigration into the thing. Now, when I look at our government, you see something and you always wonder, is this some demonic conspiracy or is this plain incompetence? I'll go on the side of incompetence. The problem with immigration is we have lots of immigration, but we have the wrong kind of immigration. We have immigration it's based on this asylum business. So we let in desperate people who maybe have low skills and then we don't let them work. Whereas there are people in the world. One of the great things about America is there are people all over the world who want to come to the U.S., adopt U.S. values, work hard, pay taxes, pay for our Social Security, start new businesses, hire Americans, revitalize this place, and we don't let them in. It is literally impossible to be a legal immigrant from Mexico or India if you want to just come in and start a business, hire Americans, pay your taxes, and help us out. So what we need is a sensible immigration system where we let the talented, skilled, hardworking people of the world come assimilate to our culture, become Americans, and bail out of our problems. What we have is a completely incoherent system, which is, as you see, causing all the problems we have. I think that's just, the usual political problem in Washington. Most people, politicians I've talked to, understand this completely, but they just say, oh, well, we can't get a deal. And every time they try to get a deal, it falls apart over the usual kind of stuff. So one of many, this is a great example of all the little structural problems that are holding the U.S. back that need to get fixed. And it's very hard to get fixed these days.
The demographic angle, I think, is interesting. That's often one of the arguments that you hear when it comes to Japan, which obviously now has, at the margin inflation. But the idea that, the older a population is on average, the more disinflationary that is, the more that becomes problematic for, a starting point of high leverage on the government side. So I can see the argument, right, for immigration as a way of maybe kicking the can even further. It just lowers the average age and maybe that ends up being more inflationary. But I'm with you. I think the government's more incompetent than that.
Well, it's not really about inflation or disinflation. This is really just about the real side of the economy. And we have, we're not making babies anymore and we're not educating. And education would be another way. We need smart, skilled people to work in the U.S. economy. And one way is to get a, higher birth rate and a better education system. Another way is to let in smart, hardworking people from other parts of the world who want to come here and improve our economy. So to the extent it's about inflation or disinflation, it's about, can the government pay off its debts? One way to pay off its debts is to grow the economy, let people in and help them pay taxes. That's really the demographic inflation thing. Otherwise, I think is very oversold.
You've got the education system, given that you've obviously been in the space for a while. Are these narratives and these stories around how these academic institutions are becoming either more left or more right or whatever political leaning that is that true? I mean, is that in your experience or is that overblown? I mean, you often see these stories and they look quite concerning in what's supposed to be a bastion of free speech.
The average person, probably your average listener, has no idea how bad it is, especially at elite universities. It's very much taken over by a small group of the extreme progressive left who are canceling people and censoring people, and they've taken over scientific societies, whole ranges of things you're not allowed to ask about, and destroying the meritocratic basis of American universities, which is, that the whole idea universities are there to advance knowledge and to, bring great ideas and educate students, as opposed to universities are there to advance a particular, advocate and advance for particular social and political ideas. They've taken over many of the institutions of our society, including universities and the scientific establishment. It's worse than you think.
Where can that be traced to? I mean, it sounds almost purposeful when you frame it like that.
That's a good question. Boy, the whole history of the totalitarian left's takeover of institutions. I view it as a combined sort of political, moral, religious awakening thing. But a good reference. I just read Greg Lukianoff and Ricky Schott's Canceling of the American Mind. So they have a good historical, where did it come from? But it is, how did the English departments, which went nuts in the 1980s, take over the institutions of American higher education? Interesting question, how and why it all crumbled, sort of like the Vandals at the gates of Rome. It all crumbled as they took it over.
Any hope for that changing? I mean, I don't even know what that means, changing. I mean, it seems like that's a trend where there's no clear rule.
So I do think it's just, I'm always hopeful. I'm an optimist, but yes, there is great hope. Already there was a few, I think of myself as a classical liberal. There's a few people like us who are already pushing back on the limits on free speech, the limits on academic freedom, the people getting fired for, things they said. But the sort of standard liberals, sort of center-left Democrats who inhabit universities are becoming shocked at what's going on. And of course, after the Hamas terrorist attacks, universities have exploded, and a lot of donors are saying, what the heck is going on here, that you're hosting this sort of thing? And so starting to look hard at what's going on in universities. And, there's like a donor revolt at Penn and Harvard saying, you got to clean this place up and get back to, the search for truth, the search for knowledge, academic freedom. Yes, you're allowed to question the government's COVID, whether the government's COVID stuff is scientific or not, and not get fired or shut down or canceled on Twitter. The Twitter files, I think, were amazing revelation of the sort of things that were going on. So there's certainly, people pushing back and new institutions being formed. The University of Austin is an example. So, America's always had a great capacity for institutional reform. It's always messy, and I think we're starting to see that. I'm hopeful, at least.
All right. So as the grumpy economist, when I hear that term, that makes it sound to me like you've got a bunch of gold bars there in your basement. I'm curious about just your own personal investing, given whatever views you might have about the long term. How do you yourself allocate capital?
That's a sad news. I've been a finance professor for 30 years. I was professor of the American Finance Association, and my own portfolio is total market and the absolute lowest cost form I can. Plus, I own a house in Palo Alto, which is an expensive investment. If you want to be a successful investor, you have to put time, effort. You really have to put time and effort in. And I put time and effort into ideas, not time and effort into investing. So I don't have as much money as I might otherwise do, but I have more books. So sorry, I don't have any great tales of personal investment for you.
Well, no, so in that case, you're talking like an academic.
I do.
Yeah,
at least I talk my book. The average person who doesn't want to spend a lot of attention at it should have the lowest possible fee, broadly diversified market portfolio they can, and just sit on it. Because everything else is a zero-sum game. So for everybody who's going to win, there's somebody who's going to lose. And, look around the table at any card game, there's a sucker. Look around the table and make sure it's not you.
Maybe for the last few minutes here, again, please make sure you follow John on, just given that everyone loves to talk about AI, and an interesting direction to go in the context of academia. But how, from what colleagues of yours and from your own experience, how have some professors been trying to deal with the inherent, better way to get cheating that happens? Because now with AI, the reality is, somebody put a whole paper out there and they can even tell AI to make it sound like it's not AI, right, that wrote it. I kind of assume that presents a whole difficult and challenging dynamic for how to actually make sure that students are actually learning.
Well, grading essays is going to go down as a way of checking whether students know what they're going to do. So that's true. Maybe you're going to have them write an in-class exam if you want to evaluate students. Of course, great grades are unpopular these days anyway. Look at the number of the average grade at Harvard is something like 3.8 out of 4. They don't quote me on the number, but it's very high. So there was already a sort of a you pretend to work and we'll pretend to grade you thing going on in universities. So, but I think it's actually hopeful. AI is a tool. I mean, did you want to say, back in the day, oh, you can't use a typewriter because we can't evaluate your penmanship. So really where we want students is to be able to use. I would encourage students, yes, use the AI, but then, you're responsible for checking the AI. So if you turn in an essay, it might have a little bit better prose than it used to have, but AI hallucinates. So if you turn in an AI generated essay that says, oh, the moon is made of green cheese with beautiful prose, we're going to check those facts. And if you didn't check those facts, you're in deep trouble. So, AI is a wonderful tool for humans to use, but to use thoughtfully. And you want to teach your students to use AI like they learn to use calculators and typewriters and word processors and everything else along the way.
Do you think that has longer term implications on the appeal of just graduating and doing, the college university route? I mean, if higher learning is ultimately going to be driven by outputs from these large language models, and it's going to be much more about kind of hyper local trait skills, it seems like there could be a shift that happens in terms of what people do coming out of high school.
Yeah. And so AI certainly will put sort of a B+ level of expertise at anyone's fingertips, which is wonderful. That means, somebody who didn't have a fancy education can now benefit from that stuff. Although they have to learn to use it creatively. There's the larger question of, what is the product of higher education? It has been sort of certification of, you go to a party for 4 years and then you're branded in the elite. The Supreme Court justices all come from Yale Law School. Well, you have that, not all, many of them, you have that brand. I think that brand is, rapidly disappearing. Employers are figuring out just because you went to some fancy school doesn't mean you know anything. So I hope I'm a believer in competitive markets, that the schools that teach things that people need and improve their skills will do better, and schools that don't will see their value fall.
John, for those who want to track more of your thoughts and more of your work, obviously they can follow you on X, but where else?
X, the Grumpy Economist blog, and I have a website, johnhcochrane.com. Just Google me. I come up first, and that's who I am.
Everybody, again, please make sure you follow John. I actually personally very much enjoyed this conversation. Hopefully all of you did too. Again, this will be a podcast under Lead Lag Live on Apple, YouTube, and Spotify, and hopefully I'll see you all later in the week. I've got a number of these spaces lined up. John, I appreciate you powering through on the tech side and making this conversation happen.
Thanks. It's been a pleasure.
Thank you, everybody. Cheers, everybody.